Something happened in the stock market recently that wiped out billions of dollars in a single trading session. And if you were not prepared for it, there's a very good chance you felt it. But here's the thing. The people who actually build wealth in this market are not the ones who panic when days like that hit. They are the ones who already know what to do next. So before you make a single move, stay right here, because what comes next in this video could be the most important thing you watch all week. If you have been around TickerHawk for any length of time, you already know we do not sugarcoat things here. We talk about the market the way it actually works, not the way people wish it worked. And right now, the market is giving us something that does not show up very often, a genuine window to position yourself ahead of the next move up. That kind of opportunity does not wait around, so we're going to get right into it. But first, if this is your first time here and you want real talk about stocks, real setups, real strategy without all the noise, go ahead and hit that subscribe button right now. We put out content like this consistently, and you do not want to be the person who finds this channel 2 months too late. Now let us talk about what actually happened. The market just went through one of those days where everything sold off together. Does not matter if a stock had strong fundamentals, does not matter if the chart was looking clean. When a global sell-off hits, it takes almost everything down with it. And that is exactly what we saw. It was the kind of red day where your screen looks like a scene out of a financial horror movie. Memory stocks, tech names, growth plays, all of it came down. And for a lot of investors, that kind of day triggers one of two reactions. Either they freeze up and do nothing, or they panic, sell right into the bottom. Both of those reactions are expensive. The right move is always the third option, and that is to use the sell-off as a research session and a buying opportunity. Now here's something I want you to really sit with for a second. The stocks that get hit the hardest during a broad market sell-off are often the exact same stocks that lead the recovery. That is not a coincidence. What happens during days like this is that institutions, hedge funds, and big money players who need to raise cash quickly sell whatever they can, not necessarily whatever they want to. So you end up with high quality names getting dragged down alongside the weaker ones. And that creates mispricings. That creates setups. That creates moments where disciplined investors get to buy things at prices that, looking back 6 or 12 months from now, are going to look like gifts. So the question is not whether this sell-off matters. It does. The question is what you're going to do with it. And that is what the rest of this video is about. Let us start with the overall market picture, because context always matters. When the S&P 500 breaks key support levels during a broad sell-off, the natural thing that follows is a period of consolidation. The market does not just snap back in a straight line. What typically happens is you get a few days of choppiness, maybe some attempts to bounce that fail, and then eventually a base forms and the next leg higher begins. That is the pattern. It has played out this way more times than I can count. So if you are sitting here watching the market bounce around day to day and wondering what is going on, that is what is going on. We are in a consolidation phase. And consolidation phases, as uncomfortable as they feel in real time, are where the setups for the next big move get built. This is also the moment where the mental game of investing becomes more important than any technical indicator. Because right now, the narrative around the market is going to be negative. The financial media is going to be running headlines about sell-offs and uncertainty and economic risks. And if you let that noise drive your decision-making, you are going to end up doing what most retail investors do, which is sell near the bottom and buy near the top. That is the cycle most people are stuck in. What we try to do at TickerHawk is break that cycle by staying focused on what the data actually says, what the setups actually look like, and where the smart money is actually positioning. Now let us talk about individual stocks, because that is where the real opportunity lives right now. When a market-wide sell-off hits, it paints everything with the same brush. But not every stock deserves to be at these discounted prices. Some of them absolutely do. They were overextended, the fundamentals were questionable, and the sell-off is just bringing them back to reality. But others got dragged down simply because the tide went out, not because anything changed about the actual business. Those are the names you want on your radar right now. One of the names that deserves serious attention in this environment is Intel, ticker symbol INTC. Now, I want you to understand why this name matters right now, because it is not just about the current price. Intel is in the middle of one of the most significant transformation stories in the entire semiconductor space. The company is making massive investments in domestic chip manufacturing at a time when the geopolitical environment is creating enormous tailwinds for US-based chip production. The CHIPS Act funding, the push to reduce dependence on overseas semiconductor supply chains, the growing demand from AI infrastructure build-out, all of that runs directly through companies like Intel. And right now, because of the broad market sell-off, you are getting an entry point into this story at a much more attractive valuation than you would have had just a few weeks ago. That is the kind of setup that patient investors look for. But Intel is not the only name worth watching here. If you missed some of the memory stock runs earlier this year, and a lot of people did because those moves happened fast, this sell-off is giving you a chance to get positioned. Micron Technology, ticker symbol MU, is one of the premier memory and storage plays in the market right now. The demand for high bandwidth memory, especially the kind that gets used in AI training and inference workloads, is growing at a pace that most people are not fully pricing in yet. Micron has direct exposure to that demand, and when the AI infrastructure build-out continues accelerating, and it will, companies that make the memory that powers those systems are going to see significant earnings growth. A pullback in MU during a broad sell-off is not a reason to avoid the stock. For the informed investor, it is a reason to look harder at it. SanDisk is another name in the storage and memory space that belongs on your watch list right now. The data storage industry is going through a structural shift driven by the explosion in data creation, AI workloads, and cloud infrastructure expansion. The companies that sit in the middle of that shift have durable growth runways ahead of them. Broad market sell-offs do not change those fundamental dynamics. They just create temporary price dislocations. And then there is Salesforce, ticker symbol CRM. If you are looking for a name that combines a dominant market position with genuine exposure to the AI software layer, Salesforce has a compelling case. The company has been building AI functionality directly into its enterprise software products, and the enterprise customer base it already has gives it a distribution advantage that is very difficult for competitors to replicate. When the market gets choppy and growth names pull back, Salesforce tends to come back to prices that long-term investors find very attractive. Pay attention to where it lands during this consolidation. Now, I also want to mention something that a lot of people got caught up in recently, and that is the SpaceX trade. There was a period where SpaceX-related names were running hard, and a lot of investors chased that momentum at elevated prices. And then the sell-off came, and those names came all the way back down to where they started. That is a lesson that the market teaches on a regular basis, and it is worth making sure it lands properly. Chasing momentum after a big run is one of the most expensive habits in investing. The time to get into a strong story is before the crowd piles in, or after a pullback brings it back to a rational entry point. Trying to buy something that has already run 50 or 100% in a short period of time because you have FOMO about missing the move, that is how you end up holding the bag while the early buyers have already taken their profits. The people who bought SpaceX-related names early locked in serious gains. The people who chased it at the top are now sitting at or below their entry. If you want to participate in that story, this pullback back to the IPO range is the moment to evaluate your entry, not when it was at the peak of the hype cycle. This brings me to something I want to spend a few minutes on because it is genuinely important, and I see people get this wrong constantly. Risk management is not optional. It is not something you think about after a trade goes against you. It is something you build into every single trade before you put a dollar to work. And there are two specific risk management failures that cost investors the most money in environments like this one. The first is not taking profits when they are available. If a stock runs 30, 40, 50%, and you have not locked in any gains, you are essentially gambling that it keeps going. Sometimes it does. Often it does not. And when a market-wide event hits and that stock gives back a big chunk of those gains, you end up feeling like you lost money, even though at one point you were sitting on a significant win. The solution is straightforward. Scale out of positions as they appreciate. You do not have to sell everything. Sell enough to lock in a real return and let the rest run. That way, no matter what the market does next, you have already captured value from that trade. The second failure is not using stop losses. A stop loss is not a sign of weakness or lack of conviction in a trade. It is a mechanism for protecting your capital so that you can stay in the game long enough to take advantage of opportunities like the one we are sitting in right now. If you got into a position without a stop loss and this sell-off wiped out a large percentage of that position's value, that is a lesson. Learn it now, apply it going forward, because the investors who come out ahead over the long run are not the ones who never have losing trades. They are the ones who manage their losing trades so that the losses are small enough that the winning trades can more than make up for them. I also want to reinforce the idea of having a plan for every trade, because this is something that separates the investors who build real wealth from the ones who just feel like they are always reacting. Before you put money into any position, you should be able to answer 3 questions. What is my target? What is my stop? And what is my timeline? If this happens, I do this. If that happens, I do that. It sounds simple because it is simple, but most people skip this step because it requires them to think through scenarios they would rather not think about. The result is that when those scenarios happen, and eventually they always do, they have no framework for how to respond. They improvise under pressure, and improvising under pressure in financial markets almost always leads to bad decisions. If you are watching this right now and you feel like the last few trading sessions have been stressful or confusing, I want you to hear this. That feeling is information. It is telling you that either your position sizing is too large for your comfort level, or your risk management framework is not clearly defined, or both. And both of those things are fixable. You can size down, you can set stops, you can build the plan that you should have had before the volatility hit. The market will give you more opportunities to apply that plan. It always does. Drop a comment below and tell me which stock on this list you're watching most closely right now. I read through those comments, and it genuinely helps me understand what you all are thinking about and what you want more coverage on. And if this breakdown gave you something useful today, share it with someone who needs to hear it. There are a lot of people out there right now who are stressed about what is happening in their portfolio. And sometimes the most valuable thing you can do for someone is point them toward perspective and a plan. Now let us zoom out for a second, because I think it is important to remember the larger context we are operating in. The structural drivers that have been pushing this market higher over the last couple of years have not gone away because of a single bad trading session or even a few rough weeks. The AI infrastructure build-out is still ongoing. The demand for semiconductor capacity is still expanding. Enterprise software adoption is still accelerating. Consumer spending, while showing some signs of slowing, has not fallen off a cliff. The companies that are genuinely positioned to benefit from these long-term trends are still positioned to benefit from them. A market-wide sell-off does not change the trajectory of a company with strong fundamentals, a clear competitive moat, and a large addressable market. What it changes is the price at which you can buy into that trajectory. And right now, that price is more attractive than it has been in a while. That is the mindset I want you to carry into the rest of this week and into however long this volatility lasts. Not panic, not euphoria, just clear eyes, a defined plan, and the discipline to execute that plan when the moment comes. The investors who do that consistently are the ones who look back at periods like this one and see them not as disasters, but as defining moments, the moments where the real gains were set up. So here's what I want you to take away from today. Keep Intel, INTC, on your radar as a name with a real transformation story at a discount entry. Watch Micron, MU, if you want exposure to the memory and AI infrastructure trade. Keep SanDisk on the list for the storage growth narrative. Look at Salesforce, CRM, if you want an enterprise software name with genuine AI integration at a more reasonable valuation. And if you missed the early SpaceX-related move, evaluate this pullback as a potential entry opportunity rather than a reason to chase the next hype cycle. Pick one of these names, do your research, and get a plan together. You do not need to catch every move. You need to catch the right ones with the right setup and the right risk management in place. That is what we are here for at Ticker Hawk, giving you the framework, the names, and the context to make informed decisions with your money. If you found value in this video, make sure you are subscribed so you do not miss what comes next, because we are going to keep tracking these setups as the market works through this consolidation phase and positions for the next move. Like this video if it gave you something useful today, and I will see you in the next one.